Today, Celsius looks to claw back millions of dollars from its former CEO and other top execs. SEC Chair Gary Gensler proposes sweeping changes to which crypto companies can custody assets. And Coinbase's chief legal officer defends the company's staking as a service platform. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Crypto prices continue to climb higher for a second straight day. As of noon Eastern, Bitcoin inched closer to the $23,000 level, rising nearly 2.5%. Ether climbed more than 1%, and Doge rose more than 3% after Elon Musk tweeted a photo of his dog sitting in his Twitter CEO chair last night. Okay, let's talk about the top stories. First, Celsius and its creditors are looking to recover millions of dollars that they say were stolen by the company's top executives. A court filing published Tuesday morning alleges that former CEO Alex Mashinsky, co-founder Daniel Leon, and other top executives made negligent, reckless, and sometimes self-interested investments which caused Celsius to lose more than $1 billion in a single year. Celsius also claims the executives sold sell tokens while actively pushing the company to buy more. Now the company and its creditors are looking to get back those billions of dollars lost by the executives' conduct. We reached out to Alex Mashinsky about this story but haven't heard back. Next, FTX insiders have been subpoenaed by the new management at the crypto exchange for documents. Now, those include FTX's founder, Sam Bankman-Fried, and his father, along with Caroline Ellison, the former CEO of the failed crypto exchange's sister crypto hedge fund, Alameda, and Gary Wang, FTX's co-founder. For background, Wang and Ellison pleaded guilty to fraud charges back in December and are cooperating with prosecutors. Now, this comes after a judge overseeing bankruptcy proceedings gave the go-ahead to FTX's official committee of unsecured creditors and its leadership to serve the insiders. Court documents reveal that the insiders must produce certain documents by tomorrow. SBF has until Friday, given he has to put together a more comprehensive list. Now, of course, while all orders from the court are different depending on the specific insider, they all must hand in documents detailing communications with FTX execs. SBF must turn over all documents related to any assets of the debtors, FTX entities, and Emergent Fidelity Technologies, the holding company that he ran with Wang. One of the things SBF was specifically ordered to produce was all documents concerning his personal finances, including any investments, bank accounts, and wallets between January 2019 and now, as well as all records associated with those transactions. Last up, the SEC is considering new restrictions on which crypto companies can custody customer assets. In an open hearing this morning, Chair Gary Gensler proposed a rules change that would require crypto firms to gain or maintain registration with the agency in order to hold those assets. Right now, federal rules only include funds and securities held by investment advisors like Fidelity or Merrill Lynch, who have to hold assets at a state or federally chartered bank. This new proposal would expand the rules to all client assets. The proposed change would be the clearest effort yet by the SEC to crack down on the industry, even crypto firms that are already regulated. In a statement, Gensler said, quote, "Make no mistake, today's rule, the 2009 rule, covers a significant amount of crypto assets." He added that some crypto trading and lending platforms may claim to custody investors' crypto. That does not mean they are qualified custodians. All right, on to our main story. Ahead of Gary Gensler's proposal, Crypto World's Kate Rooney caught up with Coinbase's chief legal officer Paul Grewal yesterday. He discussed the SEC's potential rules change and what it would mean for the industry.
Let's start with the latest from the SEC on custody. Some changes here follow some other enforcement actions we've seen on other things like staking and stablecoins. What is the effect on Coinbase from the SEC's latest move here?
Well, we understand that the SEC is considering a new rule that would severely restrict the ability of state-chartered institutions to serve as qualified custodians for digital assets. It's important, Kate, to understand that custodial services are very important in the world of digital assets and crypto because, of course, the assets need to be secured and protected on behalf of customers at all times. Up until this point, state-chartered institutions have served as an effective way for digital assets to be protected, to be secured and protected in that way. And we think that the current system, while not perfect, has worked reasonably well. Unfortunately, it's our understanding that the SEC may wish to restrict the ability of states to charter institutions that are involved in this particular service, and we think that would be a huge mistake.
And custody meaning the ability to hold somebody's cryptocurrency.
Yeah, exactly. With cryptocurrencies or digital assets, the assets actually need to be held and protected and secured by some entity or some organization. And what we are expecting tomorrow are rules which would, for the first time, limit state-chartered institutions from serving as qualified custodians.
And that's the way it's worked until now. So the states have really been the one issuing these charters, allowing companies like Coinbase to hold cryptocurrency on behalf of institutional investors, for example.
Yeah, exactly. States and federal regulators have, in partnership, overseen these institutions. And it's been a process that has not been perfect, but has generally worked well, again, to keep customer assets safe and to make sure that there's appropriate oversight.
What is the fear in the SEC's mind? Why would they want to change the status quo?
Can't say for sure. Again, if you look at the history of state chartered institutions, they have served as effective custodians, certainly in the history of digital assets or cryptocurrencies. We think that there's an important issue here about federal versus state oversight and the ability of states like New York and others to do what they have always done, which is to make sure that the institutions operating their business in their jurisdictions are working effectively.
Does this essentially get rid of Coinbase's ability to store cryptocurrency on behalf of certain investors?
Well, there's a long process ahead if the SEC chooses to pursue formal rulemaking. There will be an opportunity for industry participants like Coinbase and others to comment, to provide their own input. Other stakeholders are going to have their say. So this is potentially many, many months out into the future. But we think it's very important to establish up front that the state system has worked effectively. And we think the history of customer assets being safe and protected demonstrates that.
Do you feel like there's any sort of tension between the state level regulation and what's going on at a federal level right now?
Well, I think at both the state and the federal level, there are lots of hard questions being asked. But digital assets, cryptocurrencies, sit in a very interesting place where there is both state and federal oversight in parallel. Mm-hmm. The notion that this industry, for example, is not regulated or lightly regulated, I think is belied by the fact that we have both state oversight, in our case, New York, the Department of Financial Services, as well as federal oversight at the Treasury, at the CFTC, and potentially at the SEC. So there is, I think, a complicated approach that we've adopted in this country. But questions like the custody rules really do require input from all the different actors. That's why rulemaking is so important.
What is the financial impact to Coinbase if, for some reason, custody were off the table, you were not able to operate the way you are now, and really would need to shut down that side of the business?
Well, Coinbase, of course, has a very diversified business, not only across many different products and services beyond custody, but internationally as well. And so for us, the main issue really is about proper process and proper respect for different regulators in this complicated system. I will say that I am pleased to see, if our understanding is correct, that the SEC is choosing formal rulemaking as the process by which these new standards may be adopted. It shows that the Commission, at least in certain instances, can use rulemaking to get to the right result. Elsewhere, we have seen a reliance upon a much more enforcement-focused, a regulation by enforcement approach that we think is much less productive.
So we also had some enforcement actions from the SEC earlier this week when it came to Kraken. How is Coinbase's staking offering different from what Kraken offers?
So Coinbase offers a very different type of staking service. Among those differences are, for example, that with Coinbase's staking service, the customer's assets always remain the customer's assets. Title never passes to Coinbase, it never passes to anybody else throughout the entire flow. And so as a result, there's no worry that somehow customers are losing title or losing ownership as a result of participating in the process. Another important difference is that with Coinbase's staking service, customers understand clearly what rewards they're going to enjoy as a result of participating in the staking process. And the reason for that is the network protocol, the networks themselves, through basically math, establish what rewards will be issued. And at the same time, Coinbase is very clear and transparent that the commission that it charges, that we charge, is available to the customer. It's disclosed on our help center. And so customers have no worry that somehow Coinbase, in its discretion, is going to withhold those services or arbitrarily decide what rewards they're entitled to.
Are you surprised at some of the pushback based on the public disclosures and your process of going public and making all of this available ahead of time?
We are surprised. if you go back to our S1, and I encourage anyone to read it who is interested in Coinbase, you'll see that we talked about our staking services. We talked about our digital asset listing process, the process by which we review new tokens for listing on the Coinbase exchange. All of this was disclosed not just to the SEC, but to the world. And so it is a little disappointing, to put it gently, that now years after the fact, we find ourselves questioned for the very products and services that we were very clear about in our original S1.
Why now? Do you think some of these agencies feel burned by what happened with FTX, for example?
Well, I have no doubt that FTX has dramatically impacted how a lot of regulators are thinking about the digital asset space. And to be clear, it should. That was an obvious fraud perpetrated on the market, and we think that it should result in more careful examination of these issues. The question, though, isn't whether to examine whether or not staking ought to work in a certain way or whether stablecoins ought to be issued under certain circumstances. The question is, what's the right way to get to the right answer or result? And we think a public rulemaking process is far better than one-off enforcement action.
Okay, that's all for Crypto World today, but we will be back again tomorrow, so we'll see you then.